Business fundamentally is about solving problems for people. And in my interview today with Chad Harris, you're going to find out how he does that. Let's get to it. Hey, everybody, welcome to the show. And I am really excited to welcome Chad Harris of True Wealth Investors to the show. So, Chad, welcome, and it's good to have you here.
Hey, good to be here, Mark. Appreciate it. Thank you for the invite.
Of course, man. Of course. So let's get right into it. Let's get all the pleasantries out of the way and find out. Tell us a little bit about your story and tell us a little bit about what you've been got going on.
Yeah, glad to. So I'm a full-time real estate investor out of Dayton, Ohio, and I like buy and hold investing. I don't like selling properties. And I'm kind of unique in the fact that when I got my start in real estate, I didn't have a job, I didn't have any money, and still decided to go into buy and hold investing full time. So we've done a little flipping and other things like that for quick cash, but that's very rare. I tend to focus just on buy and hold.
Man, that's something that I cannot seem to convey to other people, like why my strategy is very similar. Like I like to buy and hold, and I've got my own reasons, but everybody hears plenty from me. They want to hear from you. Why do you feel like the buy and hold investing strategy is a better fit for you rather than going out and churning a bunch of flips and or doing a bunch of wholesaling? Why does that light your fire?
Yeah, great question. I like the idea that I can do work on the front end and then the profit keeps coming for years to come.
Yep.
I just don't like that on a flip deal or a wholesale, that profit is over and done, and I need to go, chase down the next deal.
Yeah.
So in the early years, I was doing a lot of the work on the properties I was buying, fixing them up. I didn't have any money, but I had some time. And so I was spending a lot of hours, doing those deals and fixing up properties. And people didn't understand it, really what I was doing. And they would complain to me and criticize me. Why are you spending so much time working? You should be doing other things. But they didn't realize that it was a cumulative effort.
Yeah.
That each deal I got done just built on the last. And so, now I'm an overnight success. They can't believe how it happened.
I don't know who it was that said it, but it's amazing how long it takes to become an overnight success. I think
Yeah,
it was
that's
Steve
the
Jobs that
truth.
said that. Yeah, Steve Jobs. Yeah,
Yeah,
yeah.
completely.
So you did do some flips early on, and you were stacking capital to get into the buy and hold stuff, and now you just have residual income that just pays you continually. Is that what you?
Well, actually, it was the reverse.
Okay.
So when I started, I didn't have capital, but I was really passionate and I was committed to being a success, and I just wanted to provide for my family. We had just moved from overseas. And really, my job was ending, and to get another job, I would have to move away from family. And I was just ready to be near our extended family and provide a better life for my kids. And so I was going around casting a vision for my life and just telling people, hey, I'm going to be buying real estate, I'm buying houses. And that was more for me than anything, right? I was
Right.
casting a vision. This is what I'm going to do and what I'm committed to. And I noticed over and over, people would say, I always wanted to do that. I would love to do that. I just don't know how. I love watching HGTV shows, right? Those numbers look amazing. You always hear those comments.
Right.
And I realized there was an opportunity where I could let other people be involved in my business and they could be lenders. And then I could grow my business using their money and they would be excited to be in real estate. And so that's how I started my business. I would buy foreclosures, beat up distressed properties, use money from a private lender for the purchase and rehab. And then uniquely, because I didn't have a job, another income, and couldn't qualify for any bank financing, I would do the Burr strategy before it was called the Burr strategy.
Right. Yeah.
But on the refinance, I used another private lender. So I would use short-term private lenders on the purchase and long-term private lenders on the refinance. And so we bought our first 25 or so all private money, started to add some seller financing in, and didn't get a bank loan until we had 55 doors.
Right, right. So those who are not familiar with the Burr strategy, because I know that there's not everybody on here on this channel is necessarily a real estate person. Many people do follow me because they want to get into real estate, not necessarily, but a lot of small business owners watch this show. But if you're not familiar with the Burr strategy, it again, people have been doing this for years before it was actually called it, but it's buy, rehab, refinance, rent, repeat. And or maybe I did that out of order: buy,
Refinance,
rehab, rent,
yeah.
refinance, repeat. But buying the property, rehabbing the property, renting the property out so you can get cash flow in it, then refinancing the property, and then repeating, right? So that's the strategy of building up this and pyramiding up and building this this rental portfolio.
Right. And the beauty of it is that I didn't need any of my own money
Right,
because I could raise all of the purchase and rehab from a
right.
private lender. And then because I was buying good deals and with the refinance, I could get all of that initial money back. And so I didn't have to raise really a lot of money to get started, and I could recycle the money. So it was a very sustainable model to build a portfolio.
Yeah, and that's I'm glad you bring that up because there are a lot of folks who do feel constrained. They're like, man, I would love to get into that, but I don't have the money to do it. And by the time they saved up to do it, their job just doesn't allow for that, or invariably they're going to get 6 8 months down the road, and then life shows up and then wipes out their savings. So they're not able to do that. I had a very
Right. Or the
similar
whole
start.
time they're saving, the property values are going up and they're actually losing ground, right? As that money's sitting in their savings.
That's exactly right. Yeah. And I did some private money early on to do that exact same thing. And then I would go to the banks and cash out and do a, just basically sometimes most of the time I did a cash out refi, got additional cash so I could buy additional properties, paid off the private money, and then continue to repeat that up. And my problem is I grew way too fast, way too quickly. Um, and I did not build an infrastructure or an architecture, a business architecture. I just had a pile of properties and one very, very, very busy guy. So,
Yeah.
so I understand that. So talk about that a little bit. I mean, I know, let's a couple of different things there. So it's just about being creative. I mean, you may have people in your circle that are willing to loan money maybe out of a 401k or a Roth IRA or something like that, or even just private money if it's sitting around earning, well, maybe 4 or 5% in a savings account. That those are good opportunities to borrow that money and pay other people back. That's secured with real estate, right?
Correct. Yeah. And the more you get into, or the more I got into raising private money, the more I realized there are just people all over. I don't have some amazing network, right, of people with deep pockets and just money sitting around. But once I started sharing the opportunity that my business provides, I realized that it really matched what a lot of people wanted in an investment and they couldn't find elsewhere.
Right.
And so over the years, I catered to that and actually changed exactly how I structure my financing for private lenders. So when I got started, there were some myths that, some things that I misunderstood, right? Because I didn't have anybody guiding me through the process. I was just out there hustling, trying to figure it out on my own.
Hmm.
And so one of those myths right off the bat was I thought the private lenders wanted paid back right away.
Right.
And so I always structured the loans short term, either they would be paid back when I refinance the property, or if they were a quote unquote long term lender, then I would do amortizations really short, you know,
Oh, right. So,
5 year amortizations with a balloon. And that was terrible. I didn't realize it. I thought that's what they wanted. They wanted their money back.
right.
But all that really did was reduce the return that they get as a lender and increase the level of risk and the stress on my life because my cash flow was so small.
Right, because
And
the loan constant was so high on those loans. Now, for those of you who not familiar with
right,
loan constant, a loan constant is a very easy measure of how a loan is impacted how a loan will impact your cash flow. So it's a really easy calculation to calculate loan constant. You what you want to figure out is what the annualized payment would be. So figure out what your monthly payment is. So if your monthly payment is say $200, right? 200 times 12 is $2,400, right? So if that $2,400, and then you just take that annualized payment and divide that by the loan balance. So if it's, let's say it's $2,400 divided by 10,000, that would be a 24% loan constant. Now you're thinking, well, what does that have to do with the price of tomatoes? Well, it's only relative to what other debt costs you. So most people, when they start out on a mortgage, let's say I'm completely making up numbers here, but most mortgages start out with a loan constant that's very similar, especially if it's a 30-year amortization. They might have a loan constant that is maybe 7 or 8%. So the money is relatively cheap on your cash flow, right? But the reason why credit card debt is so expensive is not so much the interest, but the loan constant. Like if anybody ever hold an American Express card, you know what I'm talking about, right? Like you might have this, it might give you a $30,000 limit, but they want 3% of the outstanding balance, right? So all of a sudden you have to make a $900 minimum payment just to stay compliant, and that's not even, I mean, that's barely eating into the principal, right? So it's the loan
Right.
constant that's the problem. It's the amount of money that you have to pay per dollar. That's the problem. So you had put yourself in a very aggressive loan constant. I mean, it sounded like it kind of worked out well for you because you were able to get out of these deals, get out of the debt sooner. But man, that puts a lot of pressure on you.
Right. In the moment, that was miserable. I
That's
mean,
right.
truly miserable. But I thought that's what my lenders wanted. So
Right.
that's what I did. And then, I still remember exactly where I was sitting in a room full of other investors and heard a speaker explain just that, a loan constant,
Yep.
and how it is essentially a measurement of risk, right? The higher
Yep.
your loan constant, the higher the risk.
Yep.
And I wanted to throw up under the table. I mean, I I was
Yep.
taking massive risk, and I was essentially offering deals or investment opportunities that were very high risk to my lenders, which
Right.
is not at all what I want to do.
Right. Right.
And
Yeah.
so I started totally restructuring the deals and reducing the loan constant to as low as I can possibly get. And so
Yep.
we do long-term loans, interest only, low interest rates, which I thought all of those were not what my lenders wanted, right?
Right.
But in actuality, the as I switched and changed over to those three things, I was able to raise much more money. That was exactly what my lenders wanted. All counterintuitive.
Well, and it's funny of the judgments that we bring to a conversation, isn't it?
It is. Certainly is, and they hold us back. We don't realize it,
Yeah.
but there are limiting factors.
All the assumptions that we made about whatever it is. And in fact, I just had a call with my inner circle yesterday about negotiations. And one of those things is, when you're walking in, that's that level of self-awareness that you're walking in. There's because there's five levels or there's five components that, rather, to emotional intelligence, and which involves self-awareness, self-control, empathy, motivation, and social skills. But the self-awareness piece is recognizing how much judgment or what assumptions I'm bringing to the equation. And that can be really hard, man. That, like, you kind of walk in, you got to walk in with some assumptions. It's hard to walk in with no assumptions. But when you start recognizing that those assumptions are getting challenged, or they should be challenged, then you're like, wait a minute, is this a good deal for anybody? Right? Like, I want to make it good. You wanted to make it a win-win, but you were making assumptions that weren't true.
Right. And I was actually making it worse for,
Yeah.
myself and the lenders.
Yeah.
Yeah. And,
Yep.
and too often it takes somebody from the outside to challenge those assumptions. It's very hard for us to challenge them from the inside.
Yeah, it,
Right.
it it really is, yeah. And which is why I would advocate for having a coach. I know you do some coaching, around this thing. So you actually teach people to raise private money. Is that true?
Correct. Yeah.
Okay.
I do coaching, a 6-week program where I walk the group through the process of raising money from private lenders.
That's
And
awesome, man. Yeah. And that's
yeah,
so needed. Yeah.
It's great because people generally come in thinking, I don't have the network. I don't want to ask people for money, ask people I know for money. Nobody wants to do that.
Mhm.
And so we walk through the process of how never to ask for money, how to present opportunities and serve the people that we're talking to. And by the end of those 6 weeks, most people have their deal already financed, which is awesome to see.
It really is amazing when you said that, like, we don't want to ask people for money because many of us tend to carry around limiting beliefs. And if we have a bad relationship with money, we just assume other people have a bad relationship with money. Again, you got to think of the assumptions that we're bringing to the table. And really, at the end of the day, it's kind of like selling, but it's consultative selling. It's not like I'm going to try to convince you to do something that you don't want. It's like, hey, are you making 4% of your money? 4% return on your money, and they're like, yeah. I'm like, would you be interested in making maybe a higher return, maybe like 10, 12% of return on your money that's going to be secured by real estate? And they're like, tell me more. They may not be interested, but at least then it's like, it's just a tool in my toolbox. And it's like, well, let me explain what it looks like. I'm not going to try to convince you to do something you're not comfortable with. But if you do this, and this is how it works, I'll show you every step of the way that I'm doing it, whatever it is, whatever your process is, right? But you can
Right.
do it in a way that's saying, hey, so this is everything. If it works for you, great. If it doesn't, that's okay too. You can take that consultative based selling approach, and 99% of the people that I talk to go, oh, I can do that. Like, that's selling. That's
Right.
not,
Right.
that's not like the greasy,
There is no hard sell,
right,
there's no pressure tactics. There's not none of those negatives that people generally associate with selling, that word selling. So yeah, it is very much building rapport, getting to know the person that you're talking to, finding out what they're looking for in an investment, and can we offer an investment that fits what they want, right?
right,
And if we can, that helps them, serves our business. If
right.
we can't, that's no problem, right?
Well,
It won't fit everybody, and it shouldn't fit everybody. And
exactly. Well, and this is the interesting thing, because you got to recognize too, is like there's people who are in different stages of life than what they might be in, right? So, we might think we're in our late 20s. We'll just, go with that. But, if we're in our 40s or 50s, and we've got some wealth, we're looking ahead when we're going to be in our 60s and 70s. I would uh, to me, an annuity would be much more attractive, where I'm getting for sure money coming in every month rather than a lump sum, right? So
right,
you got to recognize that again, that emotionally intelligent piece about empathy is putting yourself in the position of the other person and say, would you be interested in a $50,000 lump sum, or would you be interested in, say, $500 a month over the course of 100 months? Something like that. You got to stop and think about it, where people go, well, who would agree to that? Well, a 29-year-old wouldn't, but a 69-year-old person might. So,
right. Yeah, one of my first lenders, actually, the way it came about was he was interested in getting into real estate, nearing retirement, wanting more cash flow, and he knew I was starting to buy real estate, and so he asked me for advice. And so I went over and I met with him and I ran through the numbers on the deal he was looking at, and we ran the numbers, and I said, "So you're excited about this deal, and it looks like you're gonna, at best, make 10% on your money, dealing with tenants and toilets and purchasing and everything else." And he's like, "Yeah, that would be really good." I said, "How about I'll deal with all those headaches and I'll pay you 10% on your money and you never have to deal with any of it. That's all my risk and responsibility." It's like, done. Let's do it. Where do we sign? Right?
can you
Why would he
start
not take
today?
me up on that offer?
Where have you been my whole life? Yeah, yeah.
Yeah, exactly. So, and then it was, a little while later, I was talking to another lender. So that lender was really happy with 10%. I
Mhm.
was talking to another lender. I was trying to reduce the cost of my loans. And so I was pitching two different types of loans, and one would be 10% and one was going to be 8%.
Mhm.
And I'll never forget, he was considering, he was listening intently. And when I got to the interest rate, because normally the interest rate is the last thing we ever talk about,
Sure.
I want them to be nodding their head and already bought in and ready for the investment. But when I got to the interest rate, he said, 10% sounds risky. Let's just go with 8%.
Oh my
I
gosh.
thought, interesting. Okay. So a lot of investors equate the return with the level of risk.
Wow.
So it did 8%, right? And thought 7% would be even lower risk. So went to 7% and 6% and continued to raise more money the lower the interest rate that I paid.
That is insane.
Yeah, and in actuality, it is lower risk, right?
Yeah.
Because as my payment is lower,
Your lower loan constant, you're able to
lower
make the
loan
payment.
cost,
Yep. You're stick compliant.
right?
Yep. Yep.
And so it's a great opportunity for them to diversify whatever investments they have and get a really steady return secured by real estate, even if that number for us as real estate investors seems low on their return.
Right.
So,
So these were 30-year amortizing loans, or what kind of amortization?
no, I do interest only,
Oh, okay. Okay.
definitely. And so we
Wow.
do a 4-year balloon, and it just the note keeps getting extended on that mortgage,
Sure. Sure.
which to me wasn't what I thought I would want, but it made sense for them because it's more like a dividend,
Right.
really,
Right.
where they leave their principal invested and they get a return. And for me, as long as I'm building my portfolio, it doesn't make a lot of sense to pay down the debt on this existing property when I can take that cash and buy the next property. As long as my living expenses don't go up and I'm not burning through that profit, I'm reinvesting it.
Right.
It's much smarter for me to only pay interest and then I have to raise less money on the future purchases, essentially.
Yeah, it does make sense as long as you're a good steward of the principal that you would be paying, right? Because if you think about it, an interest-only mortgage, you can bake in the cake a 40-year amortization, a 30-year amortization, a 15-year amortization, a 7.25-year amortization. Like you basically create your own amortization. I mean, you can set aside, I mean, because an interest-only
Right. There's no
mortgage,
penalty for paying down principal, right?
exactly. Yeah.
So when we decide to deleverage,
Right.
well, we decide to deleverage.
Right. But the really cool thing is, let's say that you, for argument's sake, and I love this approach a lot because my strategic brain is like, firing here, and I'm thinking, let's just pretend it was a 30-year am, and of course, you get this little sliver of principal, but you're playing honest banker with yourself, and sorry, I'm using a infinite banking term here, but you're playing honest banker with yourself, and you're taking those chunks of principal and you're setting that money aside, and that money would be generating, you could use that money to be generating dividends for you, right? So if that money is compounding and generating dividends for you, whether it's in an infinite banking policy, insurance policy, or even if it's just a regular savings account, the point is you're generating a return on money that is yours, right? And
Right. It's
which
not getting
the
returned.
lender's not requiring it, right?
Right.
So it's even almost like a double hit there, where you're thinking, man, this makes a lot of sense. So somebody might ask me, so you're okay to just pay interest in perpetuity? Well, I would be, as long as my cash flow was there, and if I was building the principal on the other side and setting that money aside, that makes total sense. I mean, that strategy is pretty unbelievable. I like it a lot. Yeah.
All right. Yeah, I
Yeah.
like it too.
Yeah. That's awesome.
And the lenders really like it. So
I
it's
bet.
for
Yeah.
every.
Yeah. Because they're getting, I mean, especially now, have you noticed anybody that may be more susceptible, or I don't want to say susceptible like we're being predatory, but I found that people are definitely much more open to lending money like under situations like this that have definitely taken a big hit in the stock market. It's almost like
Hmm.
they're just ripe for it, and I'm like, they watch their portfolio go down by 25%. They're like, I'm just getting out of the stock market. I can't do this anymore, because they can't handle the emotional roller coaster that comes with seeing their wealth, go up and down like that. Do you feel like there's situations like that there where people are more open to the conversation?
I haven't noticed that they necessarily took a hit, in the market or the real estate market, but I have noticed that it is generally people who have some, they are small business owners, they have generated money, they have generated investments,
Sure.
but they have a tendency, whether that's their personality or the age they're getting to where they want to reduce risk,
Right.
right? For whatever reason. And so they may be 30 years old and they just don't like the idea of risk. And so they want their retirement funds in something that is consistent, secured by real estate. Or they could be nearing retirement and just the time frame, they couldn't take a hit on the stock market and they fear they would have enough time to get that money back, right? To have that
Right.
investment rise before they needed it. And so really, whatever the reason, they have a tendency against risk.
Sure, sure. Which, if you look at it from a true equity perspective, they're really investing in bonds. You know, if you're really looking at it that way, I mean, they're investing in
There's,
a,
yeah,
giving you
yeah,
a chunk of money and just they're making the return on it. So that's pretty cool.
yeah.
Um, what are some pitfalls? I know we're getting to the end of the session here, but what are some pitfalls that you see people entering into when they are approaching people with private money? I know that's probably some of the stuff that you teach in your coaching, and I know that's stuff that you help people work through. But what are some of the pitfalls that you see people experiencing when they're trying to get into this?
Yeah. It's interesting because a lot of the pitfalls are really perspective differences, right? It's going in with that perspective that they're asking for money from the lender. Automatically, especially as Americans, we don't like being asked for money. That just sets the wrong tone. Suddenly they're in the power position and we're
Right,
almost begging from them. And so immediately that throws everything off, and
sure,
people lack confidence and become unsuccessful just from the get-go when they have that perspective. And so they need to get the perspective of serving others,
right.
helping others.
I've even
So
noticed
that's a
that
major one.
I've even noticed that when you ask, even when you go to a banker, an actual bank, hey, I want to invite you in on this deal if you're interested. Something like that. It's almost like you're inviting them rather than, oh, please, sir,
Yeah.
can I have a spot of tea? Like it's rather than begging them,
That's it.
you're asking them, hey, I've got this deal. I didn't know if you'd be interested in being part of it.
Right.
When you approach it in that way, in that more collaborative sense, and they can still say no. Like no one's in a power position. Like, and if anything, you're in the power position because you can say no to them. Like, hey, look, I've got this. I didn't know if you'd be interested in this deal or not. And all of a sudden, you can bring them in. So I'm not trying to. I
Yeah.
mean, I'm
Another
positive
one,
that is all stuff that you talk about in your coaching program. But the approach is the
definitely.
mindset
Yeah.
is all it's
Yeah.
everything.
Another one is that too often it's like us and the lender. People have the struggle where they feel like it's us and the lender, and we're asking something from them, and we have opposite or differing objectives,
Right.
right? Where the better perspective is that we're asking them to come along with us because we're building something amazing. And
Sure.
don't they want to be a part of what we're building,
Sure.
right? Our business is going to have an amazing impact in our community. Don't they want to be a part of that?
Yeah.
And so it's not necessarily the numbers. And too often, people, when they try to raise money, they go directly to the details of the house. It's 3 bedrooms, 2 baths. Nobody cares. And I'm going to pay this interest rate. That's not really what people care about, right?
Right. Right.
They want to be a part of something and know that their money is secured and they're going to get a return. But those are the secondary things. More often, they just want to be a part of what you're building. And so it's a great way we're not giving equity or anything like that, but we are in essence bringing in partners who have a shared vision for what we're doing.
That's awesome, man. And I love the fact that you keep bringing this back to vision. I know you and I have the same mentor, and I'm a very vision focused coach myself. And that is, it has to go back to the vision and ultimately the end of the day, because, people focus too many things of chasing the dollar, chasing the ideal, and they're never actually getting to where they want to be. And at the end of the day, it all goes back in the box anyway, like when the game is
That's
over,
right.
it all goes back in the box. So
Yeah.
play the game as best as you can. Well, Chad, this has been fantastic. How do people get in contact with you? How do they reach out to you? What's the best way for people to find maybe, and ask you about the resources that you've got?
Yeah, definitely. You can find out more about me at truewealthinvestors.com. I
Sure.
have a podcast, True Wealth Investors Real Estate Podcast, if anybody's interested in creative financing to build a real estate portfolio. That's my focus. And if you're interested in raising money and want to find out more about that, you can schedule a call with me at the website. Glad to do it. I really like seeing people make improvements and grow their business and have an impact on their life. That's what really gets me fired up at this stage. So I'm glad to help if anybody wants to reach out.
And that's why you're on the show, because there's a lot of ick out there in the, especially in the real estate coaching world. Many people follow me from Landlord Coach, and I still have that channel. I still have that website. I still do some landlord coaching from time to time, but I decided to become strategically less involved in the real estate space. And Chad, you were one of the ones that I feel I was doing right, and the level of ick, and I think you know what I'm talking about.
Exactly.
It's getting to a critical mass where people are just like they did 7 consecutive deals, made some money, and now they've got a coaching program. I'm like, oh my gosh, are you kidding me? Because not because they want to help people, but because they can see how much money can be made, and it's very transparent. I mean, no matter how they slice it, it's very, very transparent in that. And it's unfortunate because people, I feel like they're spending a lot of money on coaching programs, and they're just not getting they're not getting what they should, in my opinion. So
Right. Too many coaching programs aren't focused on the client and real results for
that's
that.
exactly right. That's exactly right. Yeah. So I will put all your contact information in the show notes and the description, so that way people can find you. But Chad, it has been fantastic. Any final thoughts to wrap this up, put a bow on it?
Hey, I appreciate you having me on. Really admire what you do, Mark, and that shared perspective. Just encourage everybody, build a business that really supports your dream life, supports your vision. In the end, that's what matters most, right?
It really does, man. I couldn't have said it any better. So because at the end of the day, like I said, it goes back in the box, because
Right.
we want to make be good stewards to the people that we're here and serving and everything else. So, well, thank you, Chad. Appreciate it. As always, if you thought this was helpful, please like and subscribe to the channel. And as always, please be sure to place a value on your free time, because if you don't, someone else will. And we'll see you guys next time.